Global cryptocurrency market is sitting on a $2.26 trillion valuation right now, caught in a profound tug of war between sticky inflation, aggressive Federal Reserve posturing, and a massive drain of capital flowing directly into artificial intelligence infrastructure. We are operating in a macroeconomic landscape that actively punishes speculative risk, yet digital assets are holding a baseline that defies traditional liquidity models. The Federal Reserve, under Chair Kevin Warsh, just held interest rates at 3.5 to 3.75% this past June. They have shifted their 2026 guidance higher, with 9 committee members projecting at least one more rate hike before the year ends, because inflation metrics simply refuse to cool down to target levels. You have to wonder how an asset class built on cheap capital and excess liquidity survives, let alone thrives, when the risk-free rate remains stubbornly high and giant tech companies are vacuuming up every available dollar for AI data centers.
The competition for capital is the defining dynamic of the market this year. When we look at the AI-driven capital expenditure boom from the major tech firms, we are seeing a structural shift in where liquidity goes. Those companies are spending hundreds of billions on compute power, which keeps producer prices elevated. That creates a feedback loop for inflation, pushing real yields up. High real yields are historically toxic for non-yielding assets like Bitcoin or gold. Capital allocators are looking at a guaranteed return in short-term treasuries or the explosive, tangible revenue growth in AI hardware and software. Crypto is being starved of the casual speculative capital that drove previous cycles. Institutional money is forced to be incredibly selective. That explains why the macro picture leans cautious and why we are not seeing the broad, rising tide lifts all boats market behavior that characterized the post-pandemic stimulus era.
Geopolitical tensions surrounding Iran and volatile energy prices are adding friction to that environment. Recent consumer price index data showed slight relief due to falling oil prices, which kept the immediate odds of a rate hike in check. The relief seems fragile. If a sudden spike in crude oil reverses that CPI trend, the Fed will have all the justification it needs to execute that projected hike. This constant threat of tightening liquidity forces investors into defensive postures. We see this manifested clearly in Bitcoin's market dominance, which is hovering around 56.4%. When capital is scarce and fear is prevalent, investors do not seek out new decentralized finance protocols or mid-cap layer 1 blockchains. They retreat to the oldest, most liquid asset in the sector.
Bitcoin dominance is the ultimate fear gauge for the digital asset space. At 56.4%, the market is signaling a clear preference for safety and perceived regulatory clarity. Institutional capital views Bitcoin through the lens of a digital commodity, bolstered by the spot ETF approvals that integrated it into traditional financial plumbing. We're watching Bitcoin consolidate near $63,500. This represents a roughly 50% drawdown from its 2025 all-time high near $126,000. A 50% haircut sounds catastrophic in equities, but in the historical context of cryptocurrency, it represents a relatively shallow bear market or a prolonged mid-cycle consolidation. Key support structures are clustered tightly between $62,500 and $63,000, with immediate technical resistance capping upside momentum around the $64,000 to $65,500 range. The asset is coiled, waiting for a definitive macroeconomic catalyst to dictate the next directional impulse.
That consolidation raises questions about the health of the broader ecosystem. While Bitcoin holds the line, Ethereum is painting a much bleaker picture. Trading near $1,890, Ethereum is down over 60% from its 2025 peak of nearly $4,950. It has been heavily underperforming Bitcoin for the majority of this cycle. The Ethereum to Bitcoin ratio has collapsed to multi-year lows around 0.03. This metric is crucial because it tracks the risk appetite within the crypto market itself. When Ethereum bleeds against Bitcoin, it indicates that the fundamental infrastructure of the decentralized web is losing valuation premium. If Ethereum, the largest smart contract platform and the foundation for decentralized finance, cannot maintain pace with Bitcoin, the rationale for investing further out on the risk curve disappears.
The deterioration of the ETH to BTC ratio has been a painful lesson for investors who assumed Ethereum's transition to proof of stake and its deflationary mechanics would guarantee price appreciation. The market has repriced Ethereum based on utility and competition. Layer 2 scaling solutions on Ethereum have been successful in lowering transaction fees and increasing throughput, but they have also cannibalized the base layer's revenue. When transactions move to Arbitrum or Optimism, less value is captured directly by Ethereum's native token. There is a structural change happening on the charts that warrants attention. That 0.03 ratio recently broke out of a year-long descending channel, hitting a 3-month high. We are seeing early, localized signs of relative strength. Large entities, often referred to as whales, have begun accumulating Ethereum at these depressed levels, and exchange-traded fund flows are showing a tentative tilt back toward ETH.
On-chain metrics suggest this bottom is not fully confirmed. An initial breakout in a ratio does not guarantee a trend reversal, especially when the macroeconomic headwinds we discussed are still blowing at full force. If the ratio reclaims its 200-day moving average, it could open the door to a broader altcoin rotation in the second half of the year. That conditional statement carries a lot of weight. A rotation requires fresh capital entering the system, not just existing capital sloshing from Bitcoin into Ethereum and then down into smaller tokens. Without a dovish pivot from the Federal Reserve or a significant improvement in inflation data, the liquidity needed to sustain a broad altcoin rally simply does not exist.
You have identified the core bottleneck. Capital rotation in previous cycles was fueled by net new retail and institutional inflows seeking high beta returns. The current setup requires a catalyst to unlock that sidelined capital. Over the next 6 to 12 months, we have several potential triggers. Continued institutional treasury adoption is one. As corporate treasurers look for hedges against currency debasement, Bitcoin remains a primary candidate. We could also see further spot ETF approvals for assets beyond Bitcoin and Ethereum, which would legitimize other segments of the market and provide traditional finance with regulated access points. The most potent catalyst would be a shift in monetary policy. If the inflation prints begin to cool consistently and the Fed walks back its hawkish guidance, the resulting drop in real yields would act as a massive tailwind for long-duration risk assets.
We cannot ignore the technical upgrades either. Ethereum's roadmap includes further Layer 2 scaling improvements designed to fragment data storage and drastically reduce costs across the network. If those upgrades go live without technical failures, they could spur a resurgence in on-chain activity, driving fundamental demand for block space. Technology upgrades rarely drive sustainable price action in a vacuum. They need a conducive financial environment. When borrowing costs are near 4%, a minor efficiency upgrade on a blockchain is not enough to convince a macro fund to allocate billions. The technology must intersect with favorable liquidity conditions.
That intersection of technology and liquidity is the only way sustained bull markets materialize. The current standoff between AI capital demands and crypto liquidity will likely persist until the artificial intelligence infrastructure build-out reaches a plateau, or until macroeconomic conditions force a recalibration of interest rates. Until then, the crypto market will remain a game of patience and precise positioning. The metrics we track, from the ETH to BTC ratio to Bitcoin's $62,500 support floor, are pressure gauges. They tell us how much stress the system can handle before capital is forced to reallocate. The early strength in Ethereum suggests smart money is positioning for a shift, but the lack of broad confirmation means we are still operating in a defensive regime.
The market is suspended between structural adoption and macroeconomic restriction. Capital is favoring the safety of Bitcoin while quietly probing the depths of Ethereum for value, all while the Federal Reserve and the AI sector dictate the broader flow of global liquidity. Share this episode with anyone trying to understand the macroeconomic forces shaping digital assets today.